Hi, everybody, and welcome back to Chapter 12, our last chapter in the course. All right, this chapter is going to discuss current liabilities and contingent liabilities. Okay, our learning objectives are going to include 4 items here. We're going to describe the nature, valuation, and reporting of current liabilities in the form of payables. Number 2, we're going to describe the nature, valuation, and reporting of current liabilities in the form of unearned revenues. Number 3, we will explain the accounting for losses and gain contingencies. And lastly, number 4, we're going to indicate how to present and analyze liabilities and contingencies. As with the previous chapters, some of this is going to be review, but some of this will be additional information. Okay, let's take a look first at previewing the chapter. And here are current liabilities. We have payable transactions and employee-related payables. And then we have our unearned revenues, and I think you've had some of these, and we'll discuss that in more length as we proceed. We'll move on to contingencies. Here's our gain contingencies and loss contingencies, and finally, our presentation and decision analysis. All right, on to the meat of this chapter. Here we're going to describe the nature, valuation, and reporting of current liabilities in the form of payables. What is a liability? The FASB, Financial Accounting Standards Board, has defined liabilities as, a nice academic description here, probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. I'm sure that clarifies things for everybody. Okay, you'll recall that current assets are cash or other assets that we expect to convert into cash, sell, or consume in operations within a single operating cycle or within a year, whichever is longer. Normally, I forget this operating cycle sometimes can be greater than a year. In my experience, it has not, but there are some isolated situations where it is. Current liabilities, these are obligations whose liquidation is reasonably expected to require the use of existing resources properly classified as current assets or creation of other current liabilities. The operating cycle is a period of time elapsing between the acquisition of the goods and services and the final cash realization resulting from sales and subsequent collections. Okay, the typical current liabilities include 1, accounts payable, the big one. Number 2, notes payable. Number 3, sales tax payable. Number 4, income taxes payable. And number 5, employee-related liabilities. Accounts payable sometimes are called trade accounts payable, just like with trade accounts receivable. And in this case, the balance is owed to others for goods, supplies, or services purchased on what we call open account or on credit, right? Okay, the time lag between the receipt of the services or the acquisition of the title to the assets and the payment for them. Sometimes we have terms for those sales. We have 210 net 30 or 110 end of month. They usually state the period of extended credit, commonly 30 to 60 days. Okay, now let's assume here that Target purchases $800,000 worth of merchandise from Clorox to sell in its stores. The terms are 210 net 30. So when we record the goods that we purchase on account, we're going to debit inventory to increase it and credit accounts payable to increase it by 800,000. You will notice that we have not adjusted anything for the terms. Now, a written payment differentiated from accounts payable, a written payment is formal. So these written promises to pay a certain sum of money on a specified future date, these arise here from purchases, financing, or other transactions. They are classified as short-term or long-term depending on the nature of the note, and they may be interest-bearing and in rare situations non-interest-bearing or zero interest-bearing. Let's take a look at an interest-bearing note issued here. Assume that Wells Fargo agrees to lend $100,000 to Eat Street on March 1, 2025. If each street signs a $100,000 6% 4-month note. Therefore, the principal and interest on the note would be due on July 1, 2025. On March 1, we're going to record the issuance of this note. We'll debit cash because we are getting the cash for $100,000, but we're agreeing to the terms of the note in this case. And that was going to be a liability, which we show on the balance sheet as a okay. Now, interest comes along. If Eat Street prepares financial statements semi-annually, it makes the following adjusting entry to recognize interest and expense and interest payable of $2,000 at June 30th. So on June 30th, let's go back to these terms. We started here on March 1, 4-month note. So March, April, and May, right? And then June would be, and July 1 would be our payment date. So as of June 30th, I have March, April, and May, and June. So I have interest payable here of 100,000 times 6% times 4 months as a percentage of 12 months, or $2,000. So I'm going to debit interest expense and credit interest payable. Then on July 1, 1 day later, each street must pay the face value of the note, 100,000 plus the $2,000 of interest. So we would make the notes payable wash out because we're paying off that note, so it zeroes out. We are zeroing out the interest payable that we did on June 30th and paying the entire amount of $102,000 in cash on July 1. Okay, let's look at a zero interest bearing note. In this illustration, we're going to assume that Eat Street issued a $102,000 4-month zero interest bearing note to Wells Fargo. The present value of that note is $100,000. Okay, the bank discount rate used in this example to find present value is at 5.96%. So on March 1, we're going to get our $100,000. Excuse me. We're going to create a discount on notes payable for $2,000. and credit notes payable for $102,000. That's on March 1. Now, as we look at the current liabilities, our notes payable here, $102,000. We have a discount on the notes payable, so our carrying value is $100,000. This discount is a contra account to notes payable. We show it as a reduction of notes payable, and it represents the cost of borrowing. And we debit it to expense over the life of the note. Okay. Now, here are some examples of sales tax payable. Retailers must collect sales taxes from customers on transfers of tangible personal property and on certain services, and then remit that to the proper governmental authority. I might add, the government doesn't give us any compensation for doing that. Anyway, here's some examples of some big retailers: Walmart, Best Buy, Gap. Okay, now, sales tax payable. Here's an illustration. The customer pays sales tax to the retailer. That's not the retailer's money. That's the government's money. We just collect it. We are a conduit to the government. So we do not show that as revenue. So sales tax payable. The customer then is going to pay that tax to the retailer. The retailer will remit it to the government after they have been collected. All right, let's take a look at an example. We'll prepare the entry to record sales taxes, assuming there was a sale of $3,000 when a 4% sales tax is in effect. Obviously not in California. All right, so we're going to prepare this entry, $3,000, 4%. The cash we're going to get from that sale is $3,120. We reflect the full $3,000 as our sales revenue. We don't offset that by sales taxes in any way. We do record $120 worth of sales tax is payable to the government authority, in this case, the state of California. All right. Many companies do not separate sales tax and the amount of the sale at the time of sale. Instead, the company credits both amounts in total in the sales revenue account. This gets a little tricky. So here, in illustrating that, we assume that Marshall Company's sales revenue account balance of $150,000 includes sales taxes of 4%. Prepare the entry to record the sales tax payable. So how we would do that is to take the $150,000 and divide it by 1.04, right? And that would come out 144,230.77. That's our sales. The difference of 5769.23 is the sales tax liability. So I am fond of telling the story. My HR department sometimes would multiply by 0.96 here. No, we're going to divide by 1.04 to get the correct answer here. All right, let's take a look. And here is our journal entries. We record the $150,000 of sales revenue, and then we would offset that sales revenue by the taxes payable here. The result is the correct statement in sales revenue. Okay, that looks like a good place for us to end this first video. And when we return, we'll take a look at current liabilities, income taxes payable. Until that time, bye for now.